So over the last few years, I've taken up about 5 minutes of your time before handing over to Caroline Bradley. I hope this year Caroline is working in Hong Kong for the Commission, so I'm afraid you've got me for the whole 20 minutes, but Liam and Martin are here to answer questions as well. Now, to help things along, and because we have the banking community here and things are a bit gloomy, I have included an intentional joke. But it is a regulatory joke, so I will repeat it if you miss it. But first I'm going to tell you what I'm going to talk about. Here we go. So I'm going to start talking about the theme of the seminar this year, which is corporate governance. Then I'm going to make what I think is a fairly novel argument about operational risk and why you may want to think about this risk type differently than you might at present. Then I'm going to talk about banking trends in Guernsey, then banking policy and supervision in Guernsey, and finally some divisional themes. So let's start with corporate governance. Now, the theme this year is the interaction of business culture to regulation. And when I got that theme a few weeks ago, I had to think hard about how I would relate that to banks in Guernsey. And the obvious answer for that was, well, let's talk about bank boards, because I think we all agreed that bank boards are pretty important when we're talking about business culture. So that was fine. And then I thought, well, what is relevant here? I thought, well, one issue is that we are subsidiary boards here in the banking world. We are not main boards. Does that mean that subsidiary boards act differently from main boards? And that's a good question. I looked at the internet, and there are very few studies done on this. So it led me to think that perhaps we wouldn't have the same structure and composition of boards in Guernsey for banks as we might generally, or would we? So I thought that might be a good reason to look. The other reason I thought this would be an interesting topic would be we're always asking ourselves, are we in line with international standards, Basel core principles, and so on? So I thought, well, let's do an analysis of the bank boards here to see how we compare in the hope that we are indeed, and we can prove that we are in line with international standards. So that's what the next few minutes is actually going to be about. Now, I do recognize that once one talks about the composition of boards, the inevitable elephant in the room appears, and it's called diversity. And this appeared yesterday in questions to the chairman and the managing and the director general. I'm not going to consider diversity. What I'm interested in here is how we compare with other regimes. You may think that's a good or a bad thing. I leave it to you. But I would like to comment on a practical level about diversity and what it means. And I find it quite helpful when we're talking about things to think about the root of the word. So diversity comes from the verb divertere. And what divertere in Latin means is to cause a change of direction. And I think that's quite a helpful way of thinking it. So when I have people from boards or wanting to be on boards in front of me, I'm not really, to be honest, looking at whether they're male, female, or from Mars. What I'm thinking is, can this person cause a change of direction? And if the answer is yes, then I'm very happy to see that person on the board. That's just a personal view. So, inevitably, I am going to talk about some caveats before I show you what we found. First of all, in order to find comparators with Guernsey, my team had to sort of search the internet. And they came up with all sorts of different sources. And we list these at the end, by the way. Spencer Stuart was one, the Financial Times was another, Deloitte was another. And unfortunately, all these comparators took a slightly different view of what was right to look at. So I'm afraid this isn't a streamlined approach. It does move around a bit, but I still think it gets the point across. The other thing is that we only have 14 bank subsidiaries to look at in Guernsey, and one might say, well, that's not statistically valid, and I totally agree with you. Nevertheless, 14's a fair number. I've also, by the way, included some local Guernsey insurance companies here, A, because it enables me to talk about much the same thing in my insurance speech later today, but also because I think you might be interested in that local comparison. I'd also like to say that I have no regulatory hidden message here. I am not saying for one moment that just because the average is shown, you should be up at the average. The whole point of this is just to get you to think about where your board is compared to the average. So don't read anything into this, please. So let's just together go through the next few slides and see what we've got. So this one is taken from, I think it's called Spencer Stuart, and for some reason they've chosen the UK FTSE 150, which I must admit I've never heard of before, but hey, let's go with the flow. So what have we got here? Well, the average size of the board, it's bigger for the FTSE 150, but it's about half the size here. I'm not too bothered about that. You would expect subsidiary boards to be smaller than the main board. The average, 5 or 6, 7 varies. Some I know have bigger boards, some have smaller boards. It all sort of works, I think. Average size of, average age of NEDs. By the way, NED for me is both the parental NED and the local NED. I know some of you may have views on that, but that's the way we approached it. In terms of age, well, being myself in the 50s, they're obviously all in the prime of life. 42 to 49, 59. I mean, statistically, we could argue a bit about that, but yeah, they're all in their 50s. The average age of executives, so these are the execs or the NEDs, well, even more perhaps, or again, they're all in their 50s. And the directors that are NEDs, gosh, that's pretty much the same across the board. So on that, more or less, what you'd expect. So let's keep going. Now this rather nice graph was from the Financial Times, and this is looking right across the board for all other countries. And the team have very kindly stuck in the Guernsey subsidiary banks and the Guernsey insurance companies. Well, the Guernsey subsidiaries are right on. So what I'm saying for the NEDs, this is NEDs, sorry, roughly the average is 56, and they tend to hang around for 6 years. But gosh, that's almost the same as the UK. The Guernsey insurers, I won't talk about it a lot, I'll talk a bit more about them for the insurers. It's quite interesting, the Russians are down at the bottom, so in Russia you're relatively young, but you don't last very long. Deduce that. In the United States, you hang around, you're quite old, you hang around a long time. So, we're in the same area, which I think I take some comfort about. So let's have a look at another one and see what you think of that. This one gets a little bit more interesting. So this one, I think, was taken Deloitte. So I don't know what the UK finance sector means, but basically I think it means the City of London from a Deloitte's point of view. Now, we have this issue of women. Now, of course, the United Kingdom government, I think, correct me if I'm wrong, is going for something like 25% to 30% of women on boards as a target. The City of London is down at 12.3. And let's see, well, where are we? Well, we're a little bit below it, but the numbers here, 14 subs, only 8 insurance firms, they're not too far apart, actually. So, yeah, okay, we're perhaps a little fewer, but generally in line. So the next one I find really quite interesting, the NED serving 9 years or more. Now, in the UK, of course, the Financial Reporting Council 9-year cut-off, and you're no longer independent. So that's got the UK finance sector down to about 11%. Now, we're about double that, also interestingly, in both areas. And I sort of asked myself, well, why is this? And I think it's for 2 reasons. I think we do have people here who, once they get appointed, are around locally for a very long time. Is that something to do? We haven't got enough skill set here. Perhaps we're too comfortable with them, I don't know. And sometimes, occasionally, there's a relationship forged with a parent that can go on, literally for generations. So, I don't know, perhaps you might want to think about that one. Again, statistically, not perfect, but an interesting number. And the last one I found really quite helpful. For some reason, I don't know why Deloitte's didn't put that, but there we go. As you know, we've been campaigning for several years for banks to have at least one NED. In fact, I think we made that a requirement. I have to say, for some banks, that was a bit of an uphill push. But the average is now 2, which I think is good, because it's difficult for one person to stand out on a board. I think if you've got 2 of you there as the local NEDs, or independent NEDs, I call them local NEDs, that helps. So I thought that was quite helpful. So, almost finished now. This was an interesting one. CROs, by which I think again this was Deloitte, or Chief Compliance Officers, however you want to call them. I think if I put this slide up in 2008, you probably would have had a UK number of less than 28.5, because generally CROs did not get on bank boards in those days. Now that has changed a lot for reasons you all know. It hasn't really changed in Guernsey. Is that a good thing, a bad thing? I leave it for you to consider. Don't forget, most of you will have a CRO at the parental board oversighting you. So, but it's an interesting statistic. We're lagging a bit there. I have, by the way, talked about the 14 banks, subsidiaries. I'm aware that there are 13 branches, so I didn't want to leave you guys out either. So we did look at this for branches. It's a bit more difficult because the governing body can often be across the Crown dependencies, and it can be also the holding company level. So it's a bit difficult to make these comparisons, to be honest. But actually we found more or less that the branch governing bodies are broadly in the same space as the subsidiaries, subject, of course, to the fact they don't have to have directors. The only difference was quite interesting, that there are far more, where women are really represented for branches as Chief Compliance Officer. There are a lot of women in that space. And interestingly, I checked out the European Banking Authority in London, did a report on diversity and came up with that exact point, that across banks, women are forging ahead in the compliance area rather than elsewhere, and I think that seems to be the case here. So I think that's broadly what I wanted to say on corporate governance. These slides are available. Take them as you will, but I hope you found them interesting. From my point of view, I breathe a sigh of relief. We're broadly, I think, in line with international norms. There are slight differences here, but nothing too material. So, if I may, I'd now like to go on to the other areas I identified in the synopsis. And the first is operational risk. As you know, the Basel Committee is due to change the way regulatory capital is assessed for operational risk. So I guess you're now expecting me to talk about this, but I'm not. Because I'd like to focus on what I think is far more important and far more broader, and that is changes in the nature of operational risk. Now, most people here spend a lot of time dealing with operational risk because there's a lot of it about in Guernsey banks, probably more than credit and certainly market risk. So I hope this is of some interest to you. So when we had the global financial crisis, it led to material losses in the market and the credit space. But it also led to some really big losses around operational risk. Now, I know pigeonholing losses due to one type of risk or another is not particularly meaningful. So, US mortgage CDO losses, was this due to a failure to measure credit risk or operational risk? I mean, who cares? It happened. But it does seem undeniable that operational risk mismanagement was at the heart of several types of losses. For example, financial crime fines, LIBOR and FX, rigging, PPI, interest rate sales, and so on. Now, I'd like to suggest that operational losses should lead us to change the way we think about this risk type. Now, before the crisis, we used to think about operational risk as, in the first place, mostly being a minor threat, with the exception of rogue trading. For example, the IT system might fail leading to the ATMs going out of action for a day, or a bank might have too many check frauds, or BCP processes failed when they were called on. Yeah, it's all not good stuff, but, everyone survives and life moves on. But since the crisis, the scale of operational losses, and in many cases billions of dollars, and you all know what I'm talking about, has changed the perception of operational risk. So in banking terms, a failure to manage operational risk can now be life-threatening. It may be technology, or the treatment of customers, or market behavior, or documentation, or even cross-border risk management. Another notable feature of these losses is that they have troubled several banks all at the same time. Now, before the crisis, banks tended to look at, say, a rogue trading event at one bank and say, well, it went there, but it won't happen here. And generally, they were right. But in recent times, all these operational losses have hit the whole banking sector at once. Now, I think the ubiquities of these operational losses mean that these events have been driven by common factors. LIBOR FX rigging fines have been driven by a loss of confidence in the ability of banks to act objectively. Financial crime fines have been driven by society's disappointment that the banks have failed to effectively police the legal perimeters. And rogue trading has been made possible by the increased complexity and speed of trading. I'm sure you can think of lots of other examples. I think this trend suggests that operational risk events have become less idiosyncratic than before. Instead, they are triggered by wider trends around society as a whole. Therefore, in the same way that we look for a downward slide in the economy to signal credit loss events, so we should perhaps start to consider wider societal trends as an indicator of changes in the level of operational risk. So we may need to think more as economists or sociologists when considering the next operational risk threat. Well, this all sounds very theoretical, but let me give you a practical example, which I think is sitting there. So it may be that due to low interest rates, the equity markets are currently in a price bubble, and clearly Andy Sloan thinks that. Now, eventually, this bubble, it's going to burst. At that point, some wealthy clients will claim that they were missold equity-related products by their wealth management. Now, banks are going to resist this. But unless their documentation is sound, they will be vulnerable. So seeing this economic trend, the action for banks might be check your advice documentation process now or suffer later. And there are other examples of this type of thinking. For example, equity release for an aging and possibly impoverished population. There's mismanagement of power supplies in the UK leading to business shutdowns, or increased sectoral exposure to cyber risk due to global technology changes. Now, I'm sure you can come up with examples of your own. The point I'm making is that this sort of wider thinking about operational risk is one that banks now need to engage in. I'm sorry I've possibly gone on too long about this, but I think it's an important point for Guernsey banks to think about, at least, because you do spend a lot of your time managing operational risk. Well, I'd now like to focus on the current health of the banking sector in Guernsey. It's undeniable, and I would be wrong to say anything else, that business is pretty tough here. And the main reasons, though, have got nothing to do with Guernsey. You may take some comfort in that, but I think the main reasons are as follows, that we have a fall in cross-border global trade and financial flows. We're an international centre, we get hit by that. We have seen the rise of a far more autarkic global regulatory environment, not least in the United Kingdom, as a response to the crisis. Cross-border flows are difficult from a banking point of view and a regulatory point of view to deal with. And of course, we still have low global interest rates. And remember on our website, I think something like 60 to 70% of bank profits in Guernsey still come from the net interest rate margin. Now, I don't think, frankly, until one of these factors changes, times in Guernsey are going to get appreciably better, but we can but wait. I think in my mind, the Guernsey banking sector is akin to a sort of small but well-built ship. It has met the biggest financial crisis of our lifetimes, and it has inevitably found the going heavy. But for the immediate future, the adverse winds are still blowing. But the ship is still seaworthy, and we are ready to move forward once the storm eventually dies down. Now, in the meantime, what can we do as the Commission? I think all we can do is to make sure that the ship is up to date. Now, how do we do that? Well, we do it by being good regulatory citizens. So we attend the supervisory colleges, we apply Basel III, we undertake risk-based supervision, and so on. I'd also like to say to you that we have gone out of our way to explain the Guernsey regulatory regime to other parties, not least several UK depositors, and just in case they might want to set up a bank here. And we have internally considered at commissioner level our own risk appetite for banks with particular reference to BRICS, so that if we do get an application, we can respond very quickly. And the Commission has also been reviewing the prospect of Chinese banks here through our Hong Kong office. So I wanted to assure you that we're not, as the Commission, hiding Guernsey's light under a bushel. But, of course, as I say, the winds are still blowing against us. And, of course, and we read again today, there is the possibility of a new homegrown bank here. I'm not going to talk about that. I would say just three things. There are issues there about the size of a homegrown bank. Frankly, you're going to need a balance sheet of $500 million to $1 billion to make much difference to the local economy. That's quite a sizable request. And then around that, there are issues of how do you make money in the current environment, because we're all struggling. But I would like to say that the Commission's door is completely open, and we are always ready to talk to anyone who wants to do so, and we don't charge for that. Okay, so I'd now, if I may, just go on to some policy issues. Well, this year on Basel III, we finished implementing the new requirements around the quality and quantity of capital. I'm glad to say that's now embedded. And I must say, I do feel quite proud when I go to other regulators and say, yeah, we've done all that. So we're now Basel III compliant for capital. This year, we're consulting on the new liquidity rules. And I just wanted to linger on that for a moment, not because I want to talk about the somewhat esoteric approach, but how I think it reveals how we as a Commission work with you. So, for example, the Basel Committee until recently had no liquidity rules, although it did have some broad motherhood and apple pie guidelines. I think after the global financial crisis, which was to some extent a liquidity crisis, the Basel Committee said, well, that was a mistake, and we better have some rules. Well, fair enough. So it issued the LCR and all the rest of it, and you know what I mean. So we as the Commission, we do feel obligated to implement these rules. After all, they are the collective wisdom of the G20 and of the Basel Committee. So we started to look at these rules along with our other colleagues in the Crown dependencies, various meetings in Gatwick. And the Crown dependency regulators realized that the Basel rules, if applied without change, would in effect outlaw upstreaming. Now, although many CD subsidiaries have changed their upstreaming business model, we as regulators still believe that, subject to proper controls, the upstreaming model remained valid in the particular circumstances of small IFCs such as the CDs. So, collectively, we decided to amend the Basel rules to allow upstreaming, subject to several safeguards. We also, when we looked at all these Basel rules, felt that they had not undertaken a behavioral analysis of deposits from fiduciaries. Well, it's not surprising. Basel Committee is probably below the parapet for them. So again, we decided to take our own view, although oddly enough, the European Commission decided to do the same thing. So before issuing a consultative paper, we also undertook an impact study to see how Guernsey banks would be affected by these new liquidity rules. So we also took to heart what the Basel Committee had said about its own rules, namely that banks should have their own bespoke liquidity policies, and these should be stress tested. For good measure, we have also decided to include our old mismatch liquidity rules in Pillar 2, because we think they're actually still quite useful. So, well, I won't go on about this, but the point I'm trying to make here is that the Commission is committed to implementing the Basel rules, and we do so, as many of you know, without granting ad hoc get-out-of-jail cards for individual exceptions. But we want to do so reasonably soon after their implementation, but also we reserve the right to tweak the rules when we think it right and appropriate, and to defend that in front of any oversight body that comes along. And we'll only introduce these rules after we've thought them through and after we've done an impact analysis and worked with the industry to work out the implication. So after this excitement of liquidity this year, the bad news is that it looks like we won't have much Basel III work for at least the next year or so. I hope I won't disappoint you. Because Basel III is still a bit stuck on the new Basel III credit and operational risk rules. And I reckon they won't get them out for a while, and we don't want to follow that immediately. So a bit of a breather, I'm glad to say, this year. However, in 27, there are other themes from 2015 and 16 that we are inevitably going to be looking at. One is UK ring fencing for Guernsey, and the other, insofar as we can help, the resolution authority for the bailiff, which will be decided by the Guernsey government. These are both very theoretical, remote things, but they are important, I think, that we have in place. So what does our routine supervisory work in Guernsey look like for the last year? I think it's taken two forms. One is thematic and the other is firm-based. So this year we have undertaken one thematic that affects banks, and this is around the degree of accuracy with which banks complete their regulatory returns. Now we chose this topic because the JFSC had produced a document that was really very critical of Jersey banks, but it wasn't very clear to us how material those criticisms were. Now, I'm sure, of course, Guernsey banks wouldn't necessarily follow the way of Jersey banks, but there may be a similarity here. And I think our view is that the odd mistake in filling in regulatory returns is perfectly understandable, and we all make them. But we do expect banks to have in place effective systems of controls that, together with some high-level sign-off procedures, mean that when senior management send in these returns to us, we can be confident that they're accurate. It may well be that a bank does not run itself according to the regulatory returns. I entirely understand that. And you may be using more risk-sensitive approaches. That's fine. But from our point of view, we've got to trust the returns, not least for statutory reasons. So this thematic is still going on. I don't think it will report until Q1. I'm crossing my fingers that it will say Guernsey is better than another regime. But let's see what happens. But it is very important for us to get this right. In terms of firm-based supervision, the Commission has continued with its routine supervision of banks through PRISM. And there have been no particular surprises or themes this year. But inevitably, the usual themes appear. Sorry, Oop. Oh, no, I'm still not the right one, sorry. Yeah, so the big ones are, yes, it's here, governance, outsourcing, and people. So those are the big themes. Governance, inevitably, when we do find there are problems, it inevitably, almost inevitably, goes back to the bad governance, either at the board level or at the ExCo level. And that's where we have to try to be most proactive. Outsourcing is another huge issue. I mean, you all know this. We're a big outsourcing regime. But trying to get banks to control or at least oversight outsourcing, I know it's difficult because a lot of the outsourcing is intra-group and you have to take what you're given. But it is something that we do need you to be strong on oversight and strong with contingency plans if you don't like what you see. That's something we're talking to banks a lot about. The last thing, inevitably, is what we talk about is people. And usually it's the absence of the appropriate skill set in Guernsey, particularly around MLROs and risk officers and so on. There simply aren't enough to go around. That's a reality, you know, but it's something that we struggle with in talking to you as well. So what of 2017? So I'm going to stick my neck out here, and I'm going to tell you what I think might occur and what might not occur. So I don't know if you look at that sissy thing called banana skins, but it's quite helpful, I think, for the City of London. So I'm going to call them banana skins. And I'll talk about the banana skins that I think may pop up. No surprise, top of the list, cybercrime. I need hardly say that. I think that is going to be a huge issue going forward, particularly for private banks that hold significant amount of data about their private clients. I know you would agree with that. The second banana skin for the next year or so was potential mis-selling of wealth management products. It's not because I think this is particularly prevalent in Guernsey, it's that I'm still doubtful that the documentation around the process is secure enough. And that was the result of a thematic we did last year, and we're still having this, that you do the right thing but you don't document it quite well enough to protect you, as I say, when the winds get blowing in your direction. The third and final banana skin, totally unoriginal I'm afraid, is the mitigation of financial crime across banking groups. I think this has got hugely better, but it's still something that we are seeing. I think we're now moving into a world where many countries simply will not accept that banks that materially fail in this area should continue to be licensed. And that's a global thing. I don't think we're not talking about that here. But we don't want, in any case, a Guernsey bank to fall foul of a regulator here, or to have customers and clients from another country where that country feels aggrieved because we have taken them. Well, I said I'd stick my neck out, so I'm going to tell you the areas where I think I have fewer concerns. I may be completely wrong, and you can form your own opinion, but I'm a bit more comforted on these areas. One is, I think Guernsey banks have always lent into the central London residential market and do so with low LTVs and usually using collateral. Lending into the London commercial market is more risky, but the exposure from Guernsey banks is pretty limited. Guernsey banks have a very low risk appetite for lower grade interbank or sovereign exposure, particularly after the crisis. Parental exposure, yes, it's still out there for the upstreamers, but it's unlikely to be a sectoral issue in the near future, saving the repeat of a total meltdown as we had in 2008, although there still may be individual sovereign problems. So there you have my forecast. I hope you're not taking notes, because if I'm proven wrong next year, I hope you won't tell me how wrong I was. Well, I'd just like finally to talk about divisional themes, if I may. I apologize for being inward looking, but I think it's quite interesting. So we have 16 people in the division, covers insurance as well. It also covers supervision and policy. Now, it's a pretty diverse portfolio, and you may think that we do lose something in terms of specialization. And certainly when we meet you and you bring up a subject matter expert, we may not be as expert as you. But on the other hand, there are numerous gains to be had in terms of cross-sectoral thinking and simply being joined up within the Commission. And as companies give way to branches, I think the conduct of business issues that we talk about in our division more and more will become more prominent. So one area that we still struggle with, you to be absolutely frank, is multi-license supervision. For example, a Guernsey bank might well have a POI license and a sister trust company in Guernsey. Now, we take a portfolio approach to bank supervision, but this does not mean that we supervise the fund and fiduciary licensees in the banking division. And this means we have to liaise internally to ensure that we have a joined approach to each bank. I think we're getting much better at this, but we don't, to be frank, always succeed. And that's something for us to think about. An added complication in the Channel Islands is that a bank group can be spread out across two jurisdictions. Well, I can't think of an easy solution to solving this, other than abolishing the JFSC. Great, that was the joke. So, to finish, in 2016, we are also doing our Be a Good Regulator role. So we had a week-long visit from the Central Bank of the Seychelles to talk about offshore banking. And we have supported, I think in a very material way, the development of regulation in Nevis, courtesy of funding from the British Commonwealth. So there we go. So what have I talked about? Well, I've looked at some aspects of corporate governance for Guernsey, food for thought perhaps. I've then considered operational risk, You may agree with me or not, but I hope it's raised some thinking for you. And I then talked about issues relating specifically to the Guernsey banking sector, including policy. I then talked about some local supervisory issues and the division. So I hope you found this of interest, and thank you for listening. So if you have any questions on my speech, Liam and Martin will be happy to answer them, as will I. So, thank you.